All righty. And next up, we've got in another amazing presentation coming to us. Again, I want to remind you guys that this day was made possible by BlockFi. Such an amazing educational experience for us all to be able to sort of see the future of crypto. Again, for somebody like myself, who's the stock market junkie, but hasn't made the step really over to the crypto side of things. I'm excited to be learning and seeing all of this. I'd like to welcome back Zac Prince, CEO of BlockFi, along with Chamath Palihapitiya, a man who maybe needs no introduction, but in case you aren't aware, he's one of the early guys at Facebook. I mean, he's made so many amazing early stage investments throughout the years. And without further ado, I will pass it over to you guys, Zac and Chamath. Take it away.
Thanks, Luke. Hey, everybody. Happy to be back from this morning. It's been some awesome content so far. First off, Chamath, thank you so much for joining. So I sent Chamath an email and he said, I am busy back to back all day, every day, but if I can speak before 9 a.m. Pacific time, I'll make a stop by. So thank you so much, Chamath, for joining us. I agree with Luke. You are a person that needs zero introduction these days. You're everywhere. I think you're, on the path to becoming the Warren Buffett of, a young generation of investors, and it's awesome to watch, and we're really excited to have you here. To give you a quick bit of context, this event, we had tens of thousands of people register. It's getting streamed live on YouTube right now. It's also available on the Benzinga platform. We just look like we're on a Zoom call, but there's a bunch of people watching. I don't know how to get the questions, but people might try to ask us questions. And if they get to me, maybe we'll get to that at the end. But in terms of our conversation today, I wanted to give people a few minutes of context on your background. I'm sure a lot of people are familiar with it, but a few minutes of context on your background. Discuss a little bit about, what you see in the market today and what you saw in the market 5 or 10 years ago that led you into what you're doing now. And then talk a little bit about crypto as well, which has been maybe 80–90% of the conversation so far this morning. So without further ado, can you just give us like 2 or 3 minutes? Where'd you come from? What are some of the big things that you've done in your career that led you to where you are today?
Well, first, thanks for including me, Zac, and it's great to be with you. And thanks for being flexible on when we can do this. Well, the short version of the 44-year-old long story is I was born in Sri Lanka, and at the age of 6 or 7, I emigrated to Canada. I grew up there. And then when I was 21, I moved to the United States, undergrad in electrical engineering. I kind of just, work at a startup. I worked at a bank originally, and I was a derivatives trader. And then I liked it, and it was an entree into understanding risk, and that I really enjoyed risk, and I enjoyed investing, and I enjoyed sort of putting money to work. But I didn't particularly enjoy the job per se as much as I should have probably. So after a year I left, I moved to California. I went to work for a startup. That startup was bought by AOL. I worked at AOL, ran the instant messaging group there at a pretty young age, met Sean Parker and Mark Zuckerberg. I went to work for Zuck in the early part of Facebook, was one of the kind of founding people and the senior management team, worked there until 2011. And then I started Social Capital. And in Social Capital, I originally started early stage investing. And then off balance sheet, I did a handful of non-early stage investments. And the reason I did it off balance sheet was because I thought the orthodoxy in Silicon Valley was you start venture investing and you don't do anything else, and you're supposed to be, a venture specialist. And so I bought into it. And so I was running a bunch of early stage money, always leveraging my own capital, but then, help getting the leverage of other people's as well. And off balance sheet, I made a bunch of investments in things that didn't fit into the fund. So Bitcoin in 2012, the Warriors in 2011 or 2012. And then 2014, I made a big decision to sell all my Facebook stock. And kind of went through a long underwriting process and moved it all into Amazon. That pulled me into the public markets. I started investing there. 2015 and 16, I made a fairly large investment in Tesla. And along the way, what I realized was the historical definition of how to invest, I thought, didn't make sense to me. And so by that point, as you had said, we had a fairly good track record in early stage investing. And so I tried to return sort of the outside capital and just decided to focus on being able to do it myself with the goal of eventually making it accessible to everybody. You know, my biggest takeaway now after 10 years of investing professionally is I would really like to be in the business of helping normal, ordinary folks make money. And I just got a little exhausted with, you know, only helping rich people get richer, which kind of just became not as interesting to me. So that's my short version.
That's great. And I wanna unpack a few of the things that, you know, kind of you learned and that culminated in you getting to where you are today and what you're focusing your time on today. So going back to Facebook, what was, you know, there's some stuff in the news now. There's the Netflix documentary about social networks, and I know you were responsible for growth, but what were some of the things that you learned or you felt that you kind of cracked the code on at Facebook that helped them succeed, that could potentially be valuable for folks who are, you know, working at a technology company now and watching this and aspiring to, you know, grow that business substantially?
Well, there's a conventionally held belief which is that the, you know, winners write history. And how that plays itself out in Silicon Valley is that we end up lionizing success stories and we gloss over the actual details of how it got there. And invariably what happens is people, the most powerful way to fund ego is to pretend that a lot of the innovations that you came up with were divine intervention. What I learned at Facebook was that that's not true. And what really happens is a lot of toiling and iteration, a lot of thankless, non-glamorous, you know, focusing on tactics. It's the concept of very slow, methodical compounding. It's about stacking a bunch of very small gains together that over time create a durable moat and a long-term competitive advantage. Those were all terms that had been written down and passed along. But in success, people would throw that narrative, which was the real story, out the window, and instead they would replace it with, I invented this, and I created that, and I had a vision for this. And honestly, it's just a crock of horseshit. The reality is that most people that start companies don't know what they're doing. That's both good and bad. The good part about not knowing what you're doing is that you're very open-minded to change and to iteration. The bad part is that sometimes you can be very insecure about your success and then need to paint it in a light that's not accurate. And I think that happens a lot in Silicon Valley. I think the real story of Silicon Valley is actually more one of methodical iteration versus grandiose invention. Because the things that ultimately end up causing, you know, revolutions have started in iteration. So that's probably the biggest lesson I learned, is that being able to delay gratification, focusing on small successive improvements, you know, being patient. And so the same lessons that make you a very good entrepreneur, it turns out, can make you a very good investor if you can really focus on them and then pay attention to them and, you know, create guardrails that you can come back to, checklists, if you will. In many ways, like, success is very, very boring if you're willing to take a longitudinal 30 or 40-year view about how to get there. That's probably the most important thing I learned.
Yeah, that makes a ton of sense. And I want to ask you almost the exact same question about your time at Social Capital and what you learned there. But before moving to Social Capital, would there be anything that you would add in terms of the Facebook experience as it relates to Facebook becoming publicly traded, and whether that created an advantage that y'all were able to leverage in any way, shape, or form that may have informed your opinions that you have now as well?
I think that we should have gone public a year or two earlier. I think had we done that, we would have been forced to pay attention to the transition to mobile sooner. I think in that transition, it was also early days where there was a credible chance that Facebook could have been a third pillar of the mobile ecosystem beside iOS and Android. I think if that had come to pass, it would just be a very different business because you would be optimizing and building a completely different form of revenue than what it is today, which is entirely ad-based. And I think then the value trade-offs and the judgments that the company would have made would have been totally different. Would it have been as successful? I think that there are many scenarios in which it would have been as successful. I think there are also many scenarios where it would have been more successful. And there are probably some scenarios where it would have been less. So it would not have been without risk. And it's hard to, push back against a counterfactual that's produced a, $800 billion company. But I think that that's probably the most unemotional, detached takeaway that I would have, which is that at the point in time in which when the company went public, I think that it underinvested in moving further down the stack and becoming a more vertically integrated third alternative in the mobile landscape. And I think that that's had, material impacts on its decisions, but also the ecosystem's decisions on how it works. And I think with more money, you could have been a little bit more aggressive and taken more bets. I think in general, there was, again, a narrative fallacy that perpetuated in Silicon Valley, in part because of Facebook's decisions to stay private longer, that staying private longer was the right decision, that all of a sudden it somehow conferred a higher probability of success. And in fact, I actually think it tends to be the opposite. It sort of constrains decision-making in some ways, just because, you're not nearly as transparent as a private company as you are as a public one. And I think in that transparency, instead of just having 8 board members, opine once a quarter, having 8,000 people opine every day may sound scary to you, but in that there's a lot of good opinions in there. The perfect example is, I think, Tesla, which, in my opinion now is on a death march to being the largest company in the world. It'll be on the scale of Apple. It'll be probably larger than Amazon. And the reason is because, they've really had to be transparent, excruciatingly transparent, both about their plans, their objectives, their failings, their successes. And I think it's created a posture within that company that's creating a set of decisions that can now support an enormous outcome, which is, the complete deregulation of power, which is, a multi-trillion-dollar market opportunity for them. So in many ways, I think that if people, especially entrepreneurs, went back to first principles and actually underwrote, really building a 50-year advantage, you would look at companies like Microsoft, which went public after 4 or 5 years, Google, which went public after 5 or 6 years, Tesla, which went public after 6 years, and actually say, I want to be like them, versus, being in the line of sight of a bunch of short-term folks or a bunch of regulators and having made a bunch of decisions that I can't change because it's too late.
Yeah, I think it's so exciting seeing how companies who get public and are on a trajectory of companies like some of the ones you mentioned, the ambitions just get bigger and bigger. And there's a misconception that that can be harder to do if everyone's watching you. And you're making a very great point that the opposite is probably true in a lot of cases. So going to social capital in your time, investing in earlier stage companies, was there, anything in particular that, you picked up on there that you would highlight for folks that has gotten you to where you are today, either in terms of what you saw in the private equity market dynamics or in terms of, trends you identified in some of the most successful investments that you made of, the founders of the company or the things that the company was going after and doing?
I've learned a bunch of things. I'll just give you the laundry list, and it may be in stack ranked order, but I'm not quite sure. So the first is that incentives really matter when you construct an investment partnership. And my first iteration, I didn't get it quite right. I think I had a lot of incredibly good people that I'm very proud to have worked with. I also think I had a couple of bad apples who were frankly really greedy and focused on their own success at the sake of everybody else's. They were focused on their own credit at the sake of the organization's credit. And they were focused on their own compensation at the sake of everybody else's compensation. And I think those, two people kind of ruined it for me. And so that was a takeaway around sort of what really matters in an organization. It's really better to optimize for the integrity of the people around you. And it just takes a long time to figure out somebody's integrity. And so, at the most senior levels of a company, my advice to CEO is just to be so methodical, almost to the point of, haltingly slow when you're adding senior people, just because it just takes a while for us to really see what their real incentives are. And it's easy to make mistakes. And when you do make mistakes, don't beat yourself up about it. Transition that person out really quickly, because if they're cancerous to you, they're probably cancerous to the other people that you've hired who are like you or have the same beliefs as you. So that's one huge takeaway. The second thing that I learned at Social Capital was the value of data in decision making. And specifically, what I would say is that people obsess about too many variables that are out of their control. Market size, TAM, SAM, all these kind of terms that people use to try to prognosticate the future. And instead, there is ground truth level data, first, second, third derivative data, sitting inside of every company that has actually built something. And the skill is in figuring out which of those signals will scale and learning how to pay attention to them. And that, I think, is a technological problem that requires some sophistication of data science and analytical capability. The second thing that I learned around the investing part is that you have to have a model of risk that you're operating from. And in my model of risk, I view things as a barbell. And at the early stage, what I realized pretty quickly was that no decision was all that important. And now that may sound pejorative, but let me explain it. So many ideas in the early stage are very hard to understand, because really what you're betting are on people's ingenuity, their ability to see an opportunity and exploit it, but then also, if that opportunity doesn't work, their ability to pivot and change. And so really what you are going to figure out with the people you're investing in is their mental flexibility. So you can't really stress over these decisions too much, as long as they fit into a framework where you can manage the losses. It's that loss aversion that sometimes prevents you from making the best investments. And I think I learned that. And so, that was about then giving a bunch of folks on our team a lot of latitude and freedom in making their own decisions and distributing power to the edges of the investment authority, to the edges of the organization, maybe at small quantums of capital. But what is small to one person may be large to another. And giving an early investor in their career the ability to write a $100,000 check without asking anybody is very empowering and liberating. And lo and behold, you find some incredible things that they invest in. So I learned to manage risk. I learned to bet on people. I learned to not overthink things because there's so much data that isn't known. I learned to analyze the data that is knowable and try to extrapolate with good, boundaries and conservatism. And I learned about team and how important integrity is.
Thanks for that. And after Social Capital, from the outside looking in, it seems like you've, very, very squarely landed on, in terms of your investment activities where you are using other folks' capital for part of it, on the SPAC vehicle. And you've kind of made SPACs in a lot of ways, high flying, lots of attention, lots of capital going into it. sector of capital markets that they are today. And people are starting to call you the king of SPACs. But how did you get there? How did you kind of find this vehicle and think to yourself that this would be a good vehicle to pursue some of the objectives that you landed on after going through those earlier experiences?
There's a process that I follow. I learned it actually from Elon, who would tell me time and time again, a lot of his success has come from first principles thinking. And okay, that's, it's easy to understand. But the quick rule of thumb in first principles thinking is you have a problem definition and you successively and iteratively keep asking why. And eventually you'll get to some commonly held belief that just isn't true. And it usually takes 5 or 6 whys until you get to this kernel of truth. And then you can unpack it and you can fix it. I was looking in 2016 in my own portfolio, and I had always endeavored to be the largest LP in my funds. I always felt that if I was the most at risk, I would make better decisions. And philosophically, I always wanted to view the people that, invested money in social capital as my partner versus my boss. And that was a very important mental distinction for me to feel like I was having fun and doing my job. But I was sort of, coming into a liquidity crisis, if you will, because I was investing hundreds of millions of dollars a year of my own money. And it was running out. And I was like, when are these companies going to go public? Why aren't they going public sooner? Why are we so liquidity constrained? Am I going to be able to support these businesses? So it was a moment of sort of deep reflection. And with my partner, Ian Osborne, we were having dinner in Hong Kong at the time. And we unpacked it at first principles. And Ian and I have known each other for a decade. And, he's a very good investor, just a very good strategist. And so we just successively kept asking why. And at the core of the reason why companies and entrepreneurs wouldn't go public, I think were a bunch of misconceptions and long-held beliefs that weren't true about complexity, time, distraction, cost, etc. And so then I just started to think to myself, like, what could we do? Ian came up with this idea of a SPAC. We spent some time understanding it, and then we thought, this has a lot of really interesting features that solve a lot of real problems. It gives you certainty of price, so it feels like a late-stage round. It's relatively fast and straightforward. If you work with a good partner, they will be there with you to shepherd you into the public markets, but then stay with you and help, the business as you're trying to build it. Because it's a merger, you have the ability to actually talk about the future and your plans for the future and your forecast and really give people a very detailed understanding. So all these things weren't possible in the traditional way. And so, we raised the first vehicle and, that merged with Virgin Galactic, and that's been successful. And so, we've kind of tried to do more of them. I think what I've also learned since then is that there's a couple of other things that happen. The first is that it really does unlock access to growth companies to a broad cohort of people that were otherwise shut out. And I think that that's really good for the ecosystem. It does create better competition in the marketplace so that, a CEO now has 3 very credible alternatives with how to go public. And they'll be able to trade off against those 3. They'll be able to, make cost of capital comparisons across those 3. Their boards will be better informed. So all of these things, I think, will create more transparency, which is just better for everybody. It's a better win for the company and, for downstream investors. My goal, Zac, just so you understand it, is I think that for the next decade, if not 2, rates are going to be at or near 0. And I think that irrespective of who the president of the United States is, they are going to spend like there's no tomorrow. And in that world, they're going to be trying to dig ourselves out of the unemployment morass that we find ourselves in. In all of this, I think that we have a really important question to ask ourselves, which is how do we give ordinary folks access to returns so that instead of talking about necessarily only Social Security or Medicare or whatever, you can actually empower people to generate reasonably good returns for themselves. And today, when one half of the whole investable universe, meaning fixed income, generates zero, I think we have to find a way of allowing sophisticated investors to understand all kinds of different ways to invest, and then exposing those to people with the right guardrails and the right information, so that they can have access to that stuff. That's why I find it so interesting. What's happening in crypto. I think that's super cool. I still don't know much about DeFi, to be totally honest with you, but it seems cool. There's all kinds of like lending and securitization products that are now emerging in enterprise SaaS. Those are really cool. There are all kinds of innovative things happening in fractional ownership, in real estate. All these things combined with a huge amount of people, in the wild that are doing incredible primary research, give ordinary folks the chance to get access to returns that were otherwise only available to the ultra rich. And I think that if I can do a small part in accelerating that, that will feel like a very important thing over the next 20 years, if you want to talk about social and societal stability.
And I want to stay on SPACs just for 1 second and then move over to your view on crypto and your view on kind of the macro environment and how younger folks or maybe someone who's got a long investing time horizon and is looking at the market today, they're going to start investing some of their assets for the first time, how you would like in a scenario analysis bucket those things. But just one last question on the SPACs. I think people are starting to learn a lot about SPAC mechanics today. It's obviously a rapidly growing sector. There's a lot of participants in it now. Peel back the curtain for us a little bit on, the short summary of your pitch to a potential investor in your SPAC or a company that might be a potential, merger target for your SPAC. What do those kind of, quick value propositions look like for both sides?
Well, I think for investors, what I think we're doing is giving them access, early access to high growth technology businesses that, in our estimation and through our diligence, we will underwrite ourselves as having a chance of being a really durable legacy business. And what people, I think, for investors are betting on are two things. One is our decision-making ability, and then the second is our access. To speak about the first, our decision-making ability is largely informed by two things. Number one is diligence process that we've been honing over a decade now that has deployed billions of dollars and made tens of billions. So I think that we've become very good at really good decision-making. We use a lot of software. We use a lot of advanced techniques of data science to try to understand a company. But we also partner that diligence with, sort of legal diligence, regulatory diligence, and then, a team of folks that really understand how public markets work. And all of that comes together in one really important decision point, which is, do we put our own money on the line and become the principal and largest investor in the transaction? So, in these SPACs, I try to target around $100 million investment in each deal. I think that that's an important point of discomfort for me personally, where I'm really paying attention. And so I really study it and I try to, help make very good decisions. And I think that in that, I think we partner really well with companies to help them understand their own business better. I think that that's a really important value prop. How do you build a 10 or 20 year durable company? The second is that the people that do that job, at least in my team, myself and my partners, have been in the Valley for 20 years. We've built some really important companies. And so we have a depth of operational experience that I think is quite rare. Myself and, you know, 4 of my partners were sort of deep in the bowels of Facebook for a long time. Another one of my partners, 2 of my partners were deep in the bowels of building Twitter. You know, we've worked at all of the sort of big, good, well-built companies in the Valley. And so we have a depth and level of operational expertise that I think can be valuable. And so we can stay on the boards and help these companies. And then the third thing is, by putting those 2 things together, there's a narrative and a translation that happens between the posture of how you're building a technology company and the posture of what you need to be as a public business that I think is valuable, and we can help bridge that gap. So that's probably the 3 most important things. Excuse me. At also a basic level, I think that helping to communicate things in a very clear, simple way, helping to connect the long tail of folks who really want to understand and will be supportive of you. I think we have a unique ability to do just because of our following. So I think that those are probably the real differentiators. At the end of the day now, like, you know, I think SPACs are very much a legitimate third alternative for CEOs. And in that, I think all of the quote unquote features that differentiated you before are no longer features. It'll come down to the principles.
Yep.
And, you know, what is their credibility and how much of their own money are they putting on the line?
I think that that makes total sense, and you could boil it down at some point to, you know, what separates a SPAC from your group, from other SPACs, and you know, your capital going into it at a significant amount, and I think that voice component to it and the messaging is huge. As someone who,
yeah, Zach, by the way, I think, like, look, you see this playing out in any market that starts to go from nascent to being at scale, which is that the markets become quite segmented, right? So for example, like, you know, in the depths of the financial crisis, Goldman Sachs went to Warren Buffett. Could Goldman Sachs have raised money from anybody? Absolutely. Was there a certain patina that Goldman Sachs got from working with Buffett? I think so. Did Warren earn that over 40 or 50 years of just being a thoughtful, you know, smart, earnest, honorable allocator of capital? I think so. Could they have found a cheaper cost of capital? Absolutely. Some people will always optimize for cost. Some people will optimize for signaling. Some people will optimize for the middle. And just like the capital markets are really deep and there are all kinds of different purveyors with different features, this industry will be no different.
So changing gears a little bit, I want to throw a scenario at you and tie it back to you know, publicly available investments for folks who aren't in you know, the echelons of asset management, personal net worth yet, where they're doing things in you know, private markets as LPs or other things. Scenario: you're a much younger version of yourself or somebody else, a general aspiring investor who's starting to have some, you know, discretionary income that they want to invest at a high level. How do you think you go about making that allocation decision now, if you're looking at things like public markets or other things that are open to you to invest in as a individual with check sizes in the thousands or tens of thousands of dollars? How do you think you kind of navigate that? And what is, off the top of your head, what does a split, kind of a reasonable split, look like in this environment?
Can you and I play this first principles game on this question?
Sure.
Okay, so so you just made that statement, and I'm gonna put words in your mouth. Okay, what you're saying is, Chamath, I can't credibly invest with $10,000. Okay, so that's your statement. All right, now try your best, Zach, to answer these questions earnestly. Why?
I do think you can invest credibly with $10,000.
Yeah, I know you think so. I'm just saying, let's just break that down. Why?
Yeah.
Well, you know, because
you don't have access
my
to
friends, I don't
Yeah.
have access to everything. Why? Well, because I'm not an accredited investor. Then I would say, well, do you need to be accredited investor? Yes. Why? Well, I want to invest in X, Y, and Z. Okay, well, are there synthetic versions of X, Y, and Z where you don't have to be accredited? Yes. Well, why don't you do those? I don't know. A lot of these answers will eventually come down to the psychology and the ego of the people around you, not you. Because people have this weird way of, sometimes sort of showing, I don't even want to call it jealousy, but this imputed negativity when people try to do things, especially when they're in stasis. So what I would encourage people to do is, it doesn't matter the quantum. What you need is a plan. My plan, and I'm not saying it should be your plan, is I like to have almost half my money in very big, chunky, concentrated investments, almost half my money in very small experimental things that can grow to be big, and some money in the middle that's just for opportunistic stuff that may come as it may. The first category I try to have to be entirely liquid. The second category, I'm willing to deal with a lot of illiquidity in return for asymmetric upside. And the middle part is a mixture of both. The biggest thing that I think people need to realize is that there's a lot of correlation in the world. And if you study things from first principles, you can figure out what things are correlated. And what you'll probably find is that certain assets that are, maybe not within reach today because you're not accredited, a different version of that asset can exist. I'll give you an example. I think that right now we are going through the fractionalization of everything. Today, you may not be able to buy, a 1982 Chateau Lafite because it's too expensive, but you can actually buy a fractional share of that bottle of wine today. In fact, somebody tweeted at me that they bought a fractional share of they bought a fractional share of a 96 Petrus. Okay. Today, you may not be able to invest in, L. Catterton's retail fund, because you're not an accredited investor, and they're a phenomenal, late stage private equity shop. They did Peloton and a bunch of these other things. But you can actually, spec shoes on StockX, and I bet you it largely performs the same way because you're, pivoting on consumer sentiment. So I think if you break these problems down, you probably can find outlets for capital where you can do the most important thing, which is number one is to practice risk allocation. Number two is to practice risk management. And then number three is to practice psychological decision-making and the ability to take a couple shots, in the face, in the body, and either capitulate because it's the right thing to do, stay where you are, or double down. And those are all decisions that you can't theorize. You have to be in the flow and be forced to make them and be okay with getting things wrong as long as you're learning. And so in my mind, the younger self, had I known what I know today, and I didn't do this because at $10,000 of savings, I was ashamed. I thought, what's the point? It's never going to work. I don't know what to do. All these other people are already doing it. You need a lot of money. It's just not true. You just need a plan. And you need to be okay starting small. And you need to be okay, not being ashamed. And that was my biggest problem. So that's what I would do. The 22-year-old self would take the 5 or 10K that I had. I would allocate it into these two buckets. I would find some interesting ways of investing in illiquid assets. The great thing in 2020, which didn't exist in the year 2000, is again, you can buy a share of a car, you could buy a share of a plane, you could buy a share of artwork. Maybe that's the right proxy for illiquid asymmetric upside investing. You could buy some crypto. On the other side, I would find a few companies and learn how to do diligence. Why do I like Apple? Why do I like Facebook? Why do I like Amazon? When do I buy? How do I underwrite it? How long am I holding it for? Can I be disciplined in the face of volatility? And learn about your own personality and your own decision making. And I think what you'll find is that a plan, reasonably well implemented, but mostly just implemented and then iterated on, will find you some amount of success. The greatest thing you have to realize is when you have tailwinds. From the year 1980 to now, interest rates went from 15% in the long bond to 0. And so you were levered long equities. If you had just been levered long, you would have been an enormous winner. Long GDP, long, American productivity, long the American consumer, you were a screaming home run winner. It was hard to not make money. Today, we have a different set of rules now at play. We've had the intersection and intermingling of financial and monetary policy. We have the Treasury and the Federal Reserve more intertwined than they've ever been. We have two presidential alternatives that are really different only in style, because the substance of their agenda both leads to spending. We have two presidential candidates who largely have the same worldview. Again, strip away the style. They're both, negative on Russia. They're both negative on China, and they both don't care about the Middle East because of energy independence. So if you look at the substance, we are now in a situation where the next decade, this president, the next, will be spending. And spending will come not in places that are dated. Nobody's going to be able to underwrite $1 trillion for coal-fired power plants. It's not going to happen, no matter how much we want coal to come back. So instead, what's going to happen is these next generation industries are going to be invested in. They'll have different labels. One will call it a Green New Deal. One will call it infrastructure spending. It doesn't matter. Strip the emotion away. We know what's going to happen. Trillions of dollars are going to get pumped by the US government into the economy writ large. And there will be a rising tide. And you need to understand that that has the potential to lift certain assets over others. Figure out what those are, be durational in your ownership of those things, and you'll do a good job.
I don't know if this was intentional or not because of the audience that we're speaking to here, but I felt like during that last response towards the end, you were reaching us towards a crescendo to talk a little bit about Bitcoin. So you've owned it. You've owned it since 2012, which you've publicly talked about. Obviously, it started as something that was in that bucket of investments for you that was, the 50% that's small with some crazy asymmetric risk. But to my knowledge, you haven't sold it. So talk just a little bit about the original thesis that you had, and then a little bit about, why you still haven't sold it and you're still holding it.
Yeah, so, all of my coins sit with institutions that they then use to run their own businesses, and instead I have shares in those companies. I did that mostly for complexity, and I didn't want to manage coins. I didn't want to have wallets. I didn't want any of that stuff. I just don't want any of it. It's easier just to manage shares. No, I don't technically own any coins anymore. These companies own the coins. And as these companies are successful, then I can be successful as an equity investor and owner in these businesses. I did that for just efficiency and just ease of use and all of this other stuff. So that's the answer to that question. When I did it, I have to give all the credit to this gentleman that is well known in the Bitcoin ecosystem, Wences Casares. So Wences basically, we were going to Las Vegas for his 40th birthday party a decade ago, and he told me about it. And when we landed in San Francisco after that weekend, I called my family office and I told them to buy $1 million worth. And I thought, okay, just take a small bet here and just see what happens. I didn't know anything about it. Over the next year or two, I then studied it because I found it more and more interesting. We had a bunch of it in our funds, actually. We started to buy some and accumulate some in our funds. We sold those too early. We should have kept them all the way along. But, we did well there as well. So, my view on this is that I think it's very important to have different kinds of insurance that have different kinds of payoffs. And I really do believe in the primacy of cryptocurrency above everything else. And I think some people find this offensive, and you shouldn't, because I think it just says you're getting emotional, and you shouldn't be emotional if you're trying to be a really good investor. I think that the first and foremost thing that crypto is a hedge against institutional orthodoxy. There is a way that the world has run for hundreds of years. There's a way that the capital markets have run for hundreds of years. There's market participants that work together in an oligopolistic fashion. And it may not be the best way for things to work in the future. And if that does come to pass, what Bitcoin will be is the primary mechanism of paying off a massive insurance policy against that market failure. And I think that that is what supports Bitcoin. I think that that's what will allow it to become a broad-based, widely held, institutionalized asset. Mike Novogratz was on before me, an incredibly smart and thoughtful guy on this space, was very, very early. I mean, like, and look what Mike Novogratz is. He is, you know, he was at the top of the pecking order of the institutionalized hierarchy. And he was the first person, you know, one of the first people to sort of jump over and see it. And as he said, you know, you see all these really credible people now moving over writ large to support it in some way, shape, or form. So I think what that means is that, you know, the institutional support for Bitcoin is very important, and it is the central thesis about the insurance policy against institutional failure. And so in that, I'm very, very bullish that it's always something that one should have on hand. Again, some people will choose to own the coins. That's how I started. Some people will choose to own shares in companies that are overexposed. That's where I am today. And I think that that's it's a really good place to be. And you know, obviously, there's going to be these other markets that flourish around it. Ethereum, you know, the DeFi market built on top of it, all of that stuff, and that's all fine and good. I think it's peripheral. My honest reaction is, I think the way that people react to it is a little too emotional for me. And so it doesn't give me enough credibility to say that there is sound underwriting principles that are causing people to speculate in this market. Speculation is fine. But if it's not rooted in some basic core fundamental principle, it's a very emotional and psychological form of expression. I don't like investing in markets that are like that. Now, everything starts that way until it becomes a little bit more institutionalized. I think that in hindsight, when, you know, I stumbled into Bitcoin in 2012, it was in the midst of that transition. And it needed shepherds like Wences and Barry Silbert to really do that. And I just followed behind those guys. In the same way, I think, you know, DeFi and other markets, when they have a handful of real people who can transition between the institutionalized world and this world, once those folks bring it into the mainstream, then I would probably pay more attention. But for right now, my honest point of view is we've never seen this intermingling of fiscal and monetary policy. We've never seen central banks and governments be so tied at the hip. So we're running an incredibly complicated experiment. We don't know what the outcome is. And so I do think it's very appropriate for each of us to find our own way of hedging the failure risk of that orthodoxy.
Very well said, Chamath. I want to be conscious of your time. We're 1 minute over. Thank you so much. This was awesome. I'm sure everybody enjoyed it. And I hope you have a great rest of your day and weekend.
Thanks, Zach. Have a great weekend. Bye.
All right. Take care, guys.